On the fly.
On the fly.
Still protesting the 20% down.
You don't need 20% down.
Don't need 20% down.
Good morning.
However, we are going to talk about why you don't in just a second.
Okay, I like that.
So,
good morning, Gail.
Good morning.
Happy very frigid Wednesday.
Frigid. You know, in fact, I think I'll get over here and warm up a little bit with you and snuggle you down.
Yeah.
You used
I
to
need a
like
blanket.
You used to like to snuggle me when you were a little shit. You used to love your mom.
I still like to snuggle. I had my youngest snuggle me for the first time in probably 2 months. She broke her collarbone, so she hasn't been laying down next to me very much. And first time last night, I was like,
Hopefully
what did I do
to deserve this?
to deserve this? So,
yeah, kids have been home all week.
yeah.
Ugh, yeah.
Home another day. My wife was a little happy when she got the call.
I'm sure.
Yesterday afternoon. So.
Yeah, I was hoping they'd call our work off, but Gail said no.
No chance of that.
You need to go to work. So today I thought we would talk about real estate terms that we use all the time that, you know, we just throw
Jargon,
out
yeah, it's like a surgeon talking about, you know, sometimes, hopefully we can break down those, the disconnect, I guess, between
because we're so used to it. Yeah, we're so used to it, you know, PMI and blah, blah, blah. So let's talk about that stuff.
Yep.
So amortization.
Yep.
What's that mean?
So amortization is the time in which you pay something back over time.
Yep.
So normally in our world, real estate, you're going to have a 30-year amortization, which means you have 30 years to pay back that loan. Sometimes we get into people that have a little more income that can afford a 15-year amortization. That typically gives them a little bit better rate, but the payments each month are much more aggressive because you're paying down that debt in half the time of the 30. Over the interest or over the life of the loan, you save a lot of money in interest. The further out you go, the more interest you're going to pay.
And
but it makes it more affordable on a 30-year.
For most people.
For most people.
Yes.
So.
Yeah, and that is principal and interest only.
Correct.
It's principal and interest only that goes towards your payment and drops down your balance every month.
So we talk about building wealth. If you're doing a 401k, a 403b, whatever, each month you're setting aside money, putting it in mutual funds, you know, ETFs, stocks, whatever. With a mortgage payment, you're putting away a little bit of principal each month. As you get closer to that end date, if it's a 30-year, once you get closer to that 30-year period, more of your monthly payment is going to clip down on principal.
Yes.
The front end is loaded with interest and there's very small amount of principal, but as you go, that shifts and swings in the principal favor.
And that's why I always tell people if they can even make a little bit extra monthly payment, even 1 or 2 times a year, it does make a big difference in what you can do.
Yep.
So PMI is private mortgage insurance, right?
And so getting back to this, long ago, there used to be a rule that you had to have 20% down, right?
Yep. When I was buying my first homes.
Otherwise, you couldn't close, okay?
Right.
The industry got smart and said, we're missing out on a lot of people that can't afford the full 20% down. Obviously, prices were lower.
Right.
But
they have good jobs.
Yeah.
They qualify, but they just don't have that 20% down. Yep.
So the industry came up with some ways in order to basically allow that. And that solution was mortgage insurance. And so if you have less than 20% down, I mean, I swear to God, I have a refi going on right now. It's 80.02%. They still have to do mortgage insurance. There's this little catch with this refi program that we're leveraging right now. And unfortunately, it's $50 too short and we can't move it anymore.
Oh.
Otherwise, we have to go reprice it and do a new interest rate lock, and rates have risen since it's complicated. It's complicated and it's damn near comical because $50 is screwing up this person's need to get mortgage insurance. But It is awesome because if you have 3% down as a first-time home buyer or someone that makes less than a percentage of the county income limits, you can come in with 3% down. You're 17 away from that 20% down, right?
Yep.
Otherwise, you wouldn't be able to get into
So that
it,
private mortgage insurance insures the lender on that 17%, up to the 20%.
Correct.
So if I put 5% down, 15% of that is the lender's. To a point. Yeah.
It protects the lender in the chance of a default.
Yes. Okay. So. Yeah. And as you gain equity, that goes away.
Yep.
Okay. Good. Yep.
You can get that canceled, if you pay for an appraisal or whatever, if you feel like you've got 20% equity.
Or do a big addition or make improvements.
You can get an appraisal depending on if it's Fannie or Freddie. They have certain guidelines. And if it does show that the value is there, we can cancel your MI.
Yep.
So
that's good.
Yep, we do a lot of those quite often.
Yep. So escrow has kind of two different meanings, really, because we have the escrow where on my side we might have some repairs that need to be done. I just had one. Repairs need to be done. There's some painting on the exterior. You can't paint the exterior now, so we have to hold funds from the seller's proceeds in escrow. The title company holds those until the repairs are done.
Yep.
Then
setting it aside to ensure it's there. You'd normally take 1.5 times the bid. So if it's $1,000 bid, $1,500 is held in escrow just in case there's any overages. Because in construction, stuff happens.
So that's held from the seller's funds normally, or what's ever negotiated on the purchase agreement. Sometimes a buyer would do it, but normally it's the seller's proceeds. And then there's the escrow side that deals with payments.
But it's the same principle. We're just holding money on the side.
Right. So a third party holds it.
So when you hear escrows on the bank side of things, that means, and these are also called impounds. I've talked to people in California, they call them impounds, not escrows, whatever. I'm sure other states call them impounds, whatever. Anyways, so what we're doing is we're setting aside a little bit of your monthly payment per month, and we're putting it in an account where when the tax bill for the summer comes up, the bank pays that.
The money's there.
Yep. When the winter tax bill comes out, we pay that. When your homeowner's insurance premium comes up, typically your anniversary date, we pay that. So instead of getting a $2,000 homeowner's insurance policy in the middle, let's say you close right around Christmas.
Right.
The next year, you're going to have a $2,000 bill.
Right.
And we're just setting aside a little bit of that every month.
And then you
same
don't
with
get
your
that
property
big bill.
taxes, same with,
Yeah.
And so we essentially put your 3 bills on auto pay related to your housing.
Yeah. And that's protection for the lender.
Yes.
Because taxes become a lien on the property.
They jump our lien.
3 years, yes, and 3 years of unpaid taxes, you go to tax foreclosure, which does jump you.
It does.
So that's extra protection for the lender.
We're protecting, and normally if you do auto pay and escrows, you've got an IB account, we can give you, I think it's up to 25 basis points of the loan, up to a certain limit, where it essentially allows you to get credit at closing. But what most of my clients do is they take a slightly better rate than what they would have gotten if they didn't.
Yeah. So auto pay is awesome.
We recognize that this is a benefit to the bank.
Mm-hmm. And you reward for it.
Yep. And when I'm saying bank, independent bank, we service our loans, which is not the case with most lenders. They sell it, to Fannie or Freddie, which was what we do, but we also retain the servicing rights.
Which
other lenders will give up the servicing rights to these huge corporations. Good luck if you've got problems.
Right.
My clients call me when we have post-close, escrows, all the time.
Yeah.
So if you need to wring someone's neck,
there you go.
I've said it before. Got a great neck for
that's
ringing.
what I love, being able to call somebody and not having to call some call center and go through 97 prompts and still not talk to somebody.
Yep. Yep, it's our people. Like I can literally have a face-to-face conversation with them.
Yep.
So
we talk a lot about getting appraisals, and what is an appraisal?
An appraisal is just a unbiased third party coming in. These people are trained,
licensed,
certified. There's different levels of it, but it is not an easy industry to get into.
I had my appraisal license.
I think I remember that.
Yep, I did. And
long ago. I remember you telling me.
Yeah. I was at I had the most certification, but I never wanted to do appraisals for the bank. I just did it more for knowledge because I love to learn. I can never learn enough. I just did it more for the knowledge and experience. I never planned on being an appraiser, but it just got where the guidelines started to tighten up so much. It's like, why am I doing this when that's not what I love to do? I love to list and sell property. So I let my license go. But that knowledge has been indispensable to me and my clients. So
Yep. So the appraiser, they look at other comparable sales in the area. They know the federal guidelines. They know what they have to do. They go out to the property. They take pictures. And tell me if I'm wrong, but my understanding is they look past clutter.
They do, yes. They look past clutter.
They would look at the size of the room, the finish of if you've got countertops, those sort of things, versus, this guy's got a bookshelf that's dusty and it's full of junk.
Oh yeah, right.
They look past that because they know the new owner would probably not have that.
Right.
So.
Yeah. And they're doing that to ensure that the mortgage is appropriate for the price of the house. Yep. And that's the same thing I do when I go look at a house, and I have so many people say, I need an appraiser. And I always ask them, for what purpose do you need an appraiser? I'm doing that with a friend in Greenville right now. She's like, I need an appraiser. I'm like, for why? Well, we want to sell the house. Well, I'm going to look at that same data that appraiser is looking at. And that's how I come up with my pricing.
Save your money, because if you're listing your house and you get an appraisal,
it's no good.
Chances are, us on the bank side of things, we can't use it because you ordered it. It wasn't to our request rules. And
lenders have their own.
We have our set of rules we have to follow. Hell, I can't even have direct contact with the appraiser. We don't have a appraisal management company. We do everything internally. So our appraisal review department talks with the appraisers instead of some third party. So the communication, if I have to get something to them, and it has happened. We had where someone needed to get back to a property, I think it was last week. We found out Tuesday night. We had the guy there Wednesday. And it was because of quick chain of communication internally. Forgot where I was going with that.
Oh my God, you're turning into your father.
But do not pay for an appraisal unless it's like, where I think it does add some value are in like divorce situations.
I do a lot of appraisals for divorce situations for attorneys.
But if you're going to sell it or you're going to buy it, like we do that as part of our process.
And so do I.
So I would say most of the time,
you don't need one.
You probably don't need one.
The bank will order it. If you're buying it, the bank takes care of ordering it, right?
I would say if you're thinking about doing an appraisal, talk to a real estate professional to see, is it a good use of your money? They're probably I know what our costs are, but to the public it might be a little higher than what banks pay because we order in bulk essentially. But save your money, talk to a real estate professional, and figure out if you really truly need it.
So DTI, we say that all the time. DTI, and everything. What the hell is that?
It is our sworn enemy. What it is, it's a ratio.
Debt to income.
So all your monthly payments. I'm not talking utilities and Verizon bill and
my
consumer car,
credit card,
student loans, side-by-sides, boat loans, second houses. I own a piece of land. You don't have to have debt on that property though, but you do have property taxes. If it's a home, you're probably going to carry homeowner's insurance. So all of those things.
And the cost involved with those.
The cost involved with that. So homeowners insurance for every property, it's vertical. Property taxes are given. All those things get added up in relation to how much income we calculate and qualify for you.
And that's your gross income.
Well, there's an asterisk. If you're self-employed, we look at net. If you get a W-2 income, then we look at gross.
Okay.
So it's our sworn enemy.
Why do you say that?
Because the higher it is, the less likely we can do
a deal.
What is trying to be accomplished.
Yeah.
So we want to see low debt income or low debt to income.
So you calculate that by dividing that.
So
debt.
if you earn $10,000 a month, and all of your debt payments, your credit cards, your student loans, your auto, property taxes for the side lot that you own, plus the homeowner insurance, property tax, principal and interest payment, mortgage insurance for this new place that you're buying, let's say that's $4,000. Okay? $4,000 debt, $10,000 income, that's a 40% ratio.
Okay.
That's very doable in my world.
Okay.
The only reason why you probably wouldn't be able to is if you've got some serious credit issues.
Yeah.
The lower that debt to income is, the better the structure is.
Yeah.
That means you've got more cushion, you've got more discretionary spending at the end of the day. If you're at a 65% debt to income, you've got problems.
Yeah.
Because let's say it's someone that works W-2, teacher, firefighter, or whatever, they're at 65. That's 65% of their gross.
Right.
We've got some issues and we need to figure something out.
So that's DTI.
Yep, DTI. Yep.
Title insurance.
Title insurance is what really protects us as the bank and the owner, in an owner's policy standpoint, from any legal claims
On that property
from the past.
So that can be a mortgage that wasn't released, right? So when they do title insurance, when we get the policy, it shows anything that shows up there as a lien. Past due water bills, real estate taxes, IRS liens, an old mortgage. So then we have to clear all those issues before they'll let us close. So if there's an IRS lien, we have to get that paid off, or it can get paid at closing. Same thing like with past due real estate taxes. That's a huge one. People don't pay their taxes sometimes. So that has to be paid at close. So we are giving free and clear title to that new buyer.
Yep.
So that's the insurance policy for that.
Insurance. Yep. And you pay that as part of your closing costs. You're not paying that every year. It's a one time. It's included on the left side of the CD.
CD, what's a CD?
Closing disclosure. So, yes.
There's one.
I should do a whole thing on the disclosure process.
Yeah, we should. Well, that'd be good. So let's talk about closing costs.
Yep.
Those fees and expenses beyond the property costs that buyers and sellers pay to complete their closing process.
Yep. So you're going to have an appraisal.
Yep.
Unless we get what's called an appraisal waiver, which you have to have, a very low risky type deal. You have to have a lot of equity in. Typically, there's got to be a lot of comps in the area that you're buying.
You got to be a good borrower.
You got to be a good borrower. That's almost like icing on the cake when we get an appraisal.
Oh yeah, I'm like, woohoo! Yeah, we don't need an appraisal.
One of the reasons for that is because if we don't need an appraisal, then the system that we're running these searches on has said we agree with the purchase price. Or in the refi scenario, we agree with the price that you kind of put in as, and if there's appraisal gap type language in the PA that you write, squashed.
Yep.
If you're not sure about if it's going to comp out, squashed.
Yep.
When you do a report like that, you open up Pandora's box.
Yep.
You don't. We like to think that we're in the ballpark of a market price, but we could be way off compared to what this third party thinks.
And they're wrong sometimes.
They are wrong. They're human. I mean,
well, I haven't been wrong yet, but maybe today.
You made a mistake like 2 weeks ago.
Today might
used it
be
for
the
the
day.
whole year, so I don't know what you're talking about.
Oh, really?
Yeah. No, but when we can get an appraisal waiver, that's awesome. It saves time and money.
Yep.
So that's part of the cost. Title insurance.
Yep.
Banks. Speaking from independent side of things, we have processing and underwriting fees. That's like $13.52, I think.
Mm-hmm.
You're gonna have a little bit of like credit type costs when
Yep.
we pull your credit. I'm trying to think what else.
But that all shows up on your closing disclosure.
Shows up on your
insurance.
closing disclosure. Yep. And then what I don't feel these are closing costs, but they're lumped in on the CD. You've got your prepaid
Insurance.
Insurance. If you buy a house, your agent is going to expect you to pay your homeowner's insurance policy a year in advance.
Your insurance agent.
So it shows up on the right side in your prepaids as a cost. The bank's not taking that money and keeping it. It's just the title company's collecting it at closing. They distribute it
to the
insurance agent.
Yep.
We're also going to, carve out some money to if there's property taxes that are due.
Yep.
And setting up your escrows. So those to me aren't true closing costs. Like
right.
they would be there if you didn't have a bank involved.
Right. Yep.
So, but it gets lumped in.
Yep.
So
what's a lien?
A lien is what we place out there as protection of our collateral.
Right. And that's what I was just talking about with title insurance. So they're looking for liens.
Yes. Yep.
So a lien can be a water bill. That's why I always like to pay the water bills when I have rentals, because if the tenant doesn't pay them, it becomes a lien on the property.
Yep.
So water bills, real estate taxes, IRS liens. If I have a land contract, you put a memorandum of land contract on that as a lien on that property, you record that. So when that property sells, they know that you need to be paid off. Yep. And that's what you do. You record
that's
a mortgage.
That's what the mortgage.
Yep, that's a lien on the property. So when somebody goes to buy that, they say, oh, Independent Bank is owed $100,000 on this.
Yep. It's our way to perfect on that collateral.
Yep. And there's all sorts of liens that can be on there.
Yep.
It can be a mechanical lien.
Junior lien claims, especially in new construction, or if you remodel your house.
Yep.
This is the reason why I get this question a lot in refi scenarios. Well, we did title insurance when we bought the house. Why are we doing it again? Well, you just made a 1,500 square foot addition. We want to make sure that the subs got paid.
Johnny Joe got paid for his construction.
That stuff happens, and you might not even realize it. Like if you burn somebody, they have their legal rights and remedies as contractors to make sure that they get their money at some point.
Yep, and they do that by filing a lien.
Yep. So that is a big reason why every time you touch, whether it's purchase or refi, you got to get title insurance.
Yep.
So
I get that question all the time.
We don't know what we don't know.
Yeah. Well, and I'll have it a lot of times like on vacant land or something where they paid cash, they got title insurance. I don't need it, but we've had them in the past where there's been IRS liens filed on the wrong property. I mean, mistakes happen.
Mistakes happen.
Yeah.
The house that my wife and I bought, there was
Who'd you buy that through?
Well, you helped, but this was 17?
Yeah.
Almost 18 years ago.
Oh my God, that gets me.
There was a legal typographical error that haunted my wife and I for
years,
15, 16 years, and it was a pain in the ass. We knew about it through the title insurance policy, or through the title work when we were buying it. We accepted what we understood, and we tried to deal with it. It's a pain.
Yeah.
So,
yeah,
you want that title insurance.
Yeah, for sure.
For sure.
All right, let's finish off by talking about points.
Okay.
What's a point?
Points are essentially prepaid interest, okay? So let's just say you've got a $100,000 loan. 1 point is $1,000, okay? People think that there's this equation of, well, if I pay 1 point, then my interest rate should go down X. It's not that clear cut. It changes, pricing changes. So there's no like general rule of thumb, okay? What you can do with points is you can essentially get a better rate than what the market is offering.
So you're buying down the rate.
You're essentially prepaying some of the interest that you would pay. And what we do, a bird in the hand's worth two in the bush, is what we're saying. If you're going to pay $1,000 on this $100,000 loan in advance, you might be getting X right now in your rate. We're going to drop that down a little bit. That $10,000 rate buy down program that is literally making me work throughout the night, that is the premise behind that. That $10,000 in this case, those are
huge
points that we're leveraging and getting a help. I locked a 3.75% rate, swear to God.
Wow.
It was a very small loan.
Yeah, but still.
So the 10,000 is a huge percentage, but I mean, it's crazy.
Yeah.
It's absolutely crazy. So, yeah, we've only got a few more of those. So I think if you haven't acted on that, you probably missed the boat.
But yeah.
Points are great because we look at it in a way of how long is it going to take me to recoup paying to get this rate down. So if I'm paying $1,000 and I can save $100 a month,
right,
it takes me 10 months to recoup
my money. Yeah.
We look at that analysis when we lock rates. We have time before you close to see, okay, do I want to bring in that extra money or not? Sometimes it doesn't make sense.
Right.
Sometimes it does.
Yeah.
But it's essentially prepaying your interest up front, and in exchange we give you a smaller or a lower rate. So.
Well, I hope this has been good information for people.
Hopefully.
Hope. We're trying to bring you some value instead of just yakking all the time. If you ever have anything you want us to talk about, though, please drop us a line. We love your suggestions. We've had some great suggestions in the past. So you ready to end? You got shit to do? Okay, let's go.
Stacking
As
up.
always, real estate, call Cathy, 616-915-2890.
And Boomer, 616-902-0796.
Thanks, guys.
Thank you. Stay warm.